Preparing for a financial analyst at Orange interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through the 3 financial statements and how they connect. The 3 statements describe performance, financial position, and cash generation. Net income from the income statement increases retained earnings, while depreciation reduces profit but is added back in operating cash flow. Capital expenditure reduces cash and increases property, plant, and equipment on the balance sheet. Working capital movements also affect cash without immediately changing earnings. I always check that ending cash on the cash flow statement equals balance sheet cash and that the accounting equation balances. While answering, focus on the income statement, balance sheet, and cash flow statement. Explain retained earnings, working capital, depreciation, and why a change in one statement must reconcile through the others. Question 2. How would you build a financial forecast for Orange? I would begin with historical trends and separate Orange's businesses, such as mobile, fixed broadband, enterprise, and equipment. Revenue would be driven by customers, churn, net additions, and average revenue per user. I would forecast operating costs by activity, then model EBITDA, CapEx, depreciation, working capital, interest, and taxes. Finally, I would build base, upside, and downside cases, compare outputs with management guidance, and test whether operating assumptions support the financial results. Make sure to cover revenue drivers, subscriber trends, ARPU, churn, costs, CapEx, working capital, scenario assumptions, historical calibration, and reconciliation to management guidance and operational performance indicators. Question 3. Which KPIs would you monitor when analyzing a telecommunications company? I would monitor mobile and broadband subscribers, gross additions, churn, ARPU, net adds, and customer acquisition costs. Network metrics such as data usage and coverage help explain future capacity requirements. Financially, I would track service revenue growth, EBITDA margin, operating cash flow, CapEx intensity, and free cash flow. The key is connecting metrics. Higher data usage may support retention and revenue, but it can also require additional network investment and pressure near-term cash generation. In your answer, talk about subscriber growth, churn, ARPU, net adds, broadband connections, network usage, EBITDA margin, CapEx intensity, customer acquisition cost, and how KPIs translate into cash flow. Question 4. How do you calculate and interpret EBITDA margin? EBITDA margin equals EBITDA divided by revenue, so it measures operating profitability before interest, taxes, depreciation, and amortization. I use it to compare trends and businesses with different asset ages, but I would not treat it as cash flow. For a telecom operator, depreciation, spectrum costs, leases, and network CapEx remain economically important. I would therefore analyze EBITDA margin with free cash flow conversion, CapEx intensity, and subscriber economics before drawing conclusions. Be sure to mention the formula, operating comparability, exclusions from EBITDA, business model differences, margin trends, and why EBITDA margin should be assessed alongside CapEx, leases, and cash conversion. Question 5. What is free cash flow, and why is it important for Orange? Free cash flow is generally the cash generated after operating needs and capital expenditure. I would clarify whether the measure is unlevered or after interest, because definitions differ. For Orange, free cash flow is especially important because fiber, mobile networks, spectrum, and technology upgrades require substantial investment. Strong EBITDA is valuable only if it converts into cash after working capital, taxes, interest, and CapEx. Cash generation ultimately supports dividends, deleveraging, and strategic investment. While answering, define operating cash flow less capital expenditure, distinguish unlevered and levered measures, discuss network investment, dividends, debt reduction, and explain why cash conversion matters more than accounting profit. Question 6. How would you assess whether Orange should invest in a new network project? I would isolate incremental cash flows rather than allocate existing costs mechanically. The model would include construction capex, rollout timing, maintenance costs, expected customer adoption, ARPU effects, churn reduction, and any avoided network expenses. I would calculate NPV using an appropriate discount rate and review IRR, payback, and downside cases. I would also consider strategic benefits, regulatory obligations, execution risk, and whether the project preserves competitiveness even if its standalone financial return is modest. Make sure to cover incremental revenue, cost savings, capex timing, operating costs, useful life, NPV, IRR, payback, sensitivity analysis, strategic benefits, and risks around adoption, regulation, and execution. Question 7. Explain working capital and how it affects cash flow. Working capital reflects cash tied up in operating assets and liabilities. An increase in receivables or inventory uses cash, while an increase in payables or contract liabilities provides cash. In telecommunications, handset sales, customer billing cycles, equipment purchases, and prepaid plans can create meaningful timing effects. I would analyze both the balance and the movement, normalize seasonal changes, and distinguish sustainable improvements from one-time collection timing or supplier payment delays. In your answer, discuss receivables, inventory, payables, contract liabilities, timing differences, the cash conversion cycle, seasonality, and how working capital movements should be interpreted in a telecom context. Question 8. How would you analyze a variance between actual and budgeted revenue? I would build a bridge from budget to actual revenue, separating subscriber volume, ARPU, product mix, foreign exchange, timing, and exceptional items. For example, weaker mobile revenue could reflect higher churn, lower pricing, or a shift toward discounted plans. I would validate the financial result against operational KPIs and investigate data quality first. Then I would determine whether the variance is temporary or structural and update the forecast using revised assumptions rather than simply annualizing the result. Focus on separating volume, price, mix, foreign exchange, timing, and one-off effects. Explain management actions, data validation, bridge analysis, and how the conclusion should influence the revised forecast. Question 9. What is a DCF valuation, and how would you use it in analysis? A discounted cash flow values a business by discounting projected future free cash flows and terminal value back to today. I would forecast operating performance, taxes, capex, working capital, and cash conversion, then apply a WACC and calculate terminal value using either perpetuity growth or an exit multiple. After deriving enterprise value, I would subtract net debt and adjust for relevant items to reach equity value. Sensitivity tables are essential because small changes in WACC or growth can materially change the result. Be sure to mention forecast free cash flow, WACC, terminal value, discounting, enterprise value, net debt, equity value, sensitivity analysis, and the danger of excessive terminal value dependence. Question 10. How do you calculate WACC? WACC is the weighted average of the cost of equity and after-tax cost of debt, using market value weights. Cost of equity commonly comes from the risk-free rate plus beta multiplied by the equity risk premium. Cost of debt reflects current borrowing costs, reduced by the tax shield where appropriate. I would ensure the inputs match the business, currency, geography, and capital structure, and I would avoid mixing nominal cash flows with a real discount rate. While answering, cover cost of equity, cost of debt, market value capital weights, beta, risk-free rate, equity risk premium, tax shield, and why country, business, and leverage risks matter. Question 11. How would you evaluate Orange's leverage and debt position? I would start with net debt, including clearly defined cash and relevant lease obligations, then compare it with EBITDA and free cash flow. I would examine interest coverage, debt maturities, fixed versus floating rates, liquidity facilities, covenants, and credit ratings. The conclusion should reflect business stability. Recurring subscription revenue can support leverage, but heavy capex and competitive pricing may reduce flexibility. I would stress test EBITDA declines, higher rates, and weaker cash conversion rather than rely on one ratio. In your answer, discuss net debt, EBITDA, interest coverage, maturity profile, liquidity, lease liabilities, rating considerations, covenant headroom, free cash flow, and sensitivity to earnings or interest rate changes. Question 12. What impact does International Financial Reporting Standards 16 have on a telecom company's financial statements? International Financial Reporting Standards 16 generally brings lessee leases onto the balance sheet as right-of-use assets and lease liabilities. Instead of recording a single operating lease expense, the company recognizes depreciation and interest, which usually increases reported EBITDA. Cash payments still occur, although classification can change between operating and financing activities. For Orange, towers, retail sites, and other property leases may be significant. I would use consistent pre- and post-International Financial Reporting Standards 16 measures when comparing periods, peers, leverage, and cash conversion. Make sure to explain lease recognition, right-of-use assets, lease liabilities, EBITDA uplift, depreciation and interest expense, cash flow classification, leverage effects, and the importance of consistent adjusted metrics. Question 13. Tell me about a time you found an error in a financial model or report. In one reporting exercise, my forecast cash balance did not reconcile with the supporting schedule. I traced the issue through formulas, checked sign conventions, and found that a capital expenditure assumption had been included twice. I corrected the model, quantified the effect on cash and leverage, and informed the reviewer immediately. I then added a reconciliation check and separate input and calculation sections. The experience reinforced that disciplined model controls are as important as analytical judgment. Be sure to mention the situation, diagnostic process, control checks, root cause, correction, communication, and preventive action, while demonstrating ownership without overstating the mistake. Question 14. How would you compare Orange with another European telecommunications operator? I would first normalize reporting definitions, currencies, accounting treatments, and business mixes. Then I would compare service revenue growth, subscribers, ARPU, churn, EBITDA margin, CapEx intensity, free cash flow conversion, leverage, and valuation multiples. A peer with stronger margins may also have older networks or different wholesale exposure, so the comparison needs context. I would separate operational performance from capital structure effects and use both trading multiples and a DCF to form a balanced view. Focus on comparable definitions, geography, customer mix, revenue growth, ARPU, churn, EBITDA margin, CapEx intensity, leverage, spectrum, accounting differences, and the risks of relying on headline multiples. Question 15. What would happen to a forecast if churn increased significantly? Higher churn would reduce the subscriber base unless gross additions increased enough to offset it. That would pressure recurring revenue and potentially ARPU if retention required discounts. Acquisition and retention costs could rise, lowering EBITDA and cash flow. Network CapEx might not decline immediately because infrastructure is largely fixed and capacity planning is long-term. I would model the impact by customer segment, test whether churn reflects a temporary issue or structural weakness, and evaluate actions such as service improvements or targeted pricing. In your answer, trace the effect through subscribers, revenue, acquisition costs, retention spending, ARPU, EBITDA, CapEx utilization, cash flow, valuation, and possible management responses. Question 16. How would you build a sensitivity or scenario analysis for Orange? I would identify the assumptions with the greatest impact, such as subscriber growth, churn, ARPU, EBITDA margin, CapEx, interest rates, and terminal growth. I would create coherent base, upside, and downside cases rather than changing one variable arbitrarily. For example, a downside case could combine higher churn, lower pricing, and delayed cost savings. I would show effects on revenue, EBITDA, free cash flow, leverage, and valuation, then explain which risks management can actually influence. While answering, cover key value drivers, base, upside, downside cases, independent and linked assumptions, tornado analysis, probability weighting where appropriate, outputs, and decision useful interpretation. Question 17. How do you ensure accuracy when working with large financial datasets? I start by confirming the source, period, currency, definitions, and population before analyzing data. I use controlled imports, unique identifiers, duplicate checks, totals reconciliation, and exception reports to identify anomalies. Calculations should be reproducible, with assumptions documented and source files versioned. I also compare results with prior periods and operational indicators, then perform a reasonableness review. Before sharing conclusions, I ask someone independent to challenge the methodology and key outputs. Make sure to mention source validation, data definitions, reconciliations, duplicate checks, sampling, version control, documentation, automation, exception reporting, and independent review before presenting conclusions. Question 18. How would you explain a complex financial finding to a non-finance manager? I would begin with the decision or headline, not the spreadsheet. For example, I might say, the forecast is lower mainly because customer churn increased, not because billing failed. I would use a simple bridge showing the quantified drivers, explain the operational cause, and state the expected financial impact. I would distinguish facts from assumptions, outline the main risk, and recommend a specific action. I would then invite questions and provide detail only where it helps the decision. In your answer, emphasize the decision first, plain language, concise visuals, operational drivers, quantified impact, assumptions, risks, and a clear recommended action rather than accounting terminology. Question 19. Why do you want to work as a financial analyst at Orange? Orange appeals to me because telecom combines recurring customer revenue with substantial technology investment and complex operating decisions. That creates a strong environment for an analyst to connect KPIs such as churn and ARPU with EBITDA, CapEx, and cash flow. I would bring disciplined modeling, attention to detail, and clear communication, while learning from a business undergoing continued network and digital evolution. I am particularly motivated by analysis that helps managers allocate capital and improve performance. Be sure to connect Orange's telecom scale, recurring revenues, network investment, technology transition, operational complexity, analytical development, and your own skills, motivation, and interest in business partnering. Question 20. If management asked you to recommend a cost reduction initiative, how would you approach it? I would segment costs into network, personnel, customer service, procurement, marketing, and overhead, then identify the largest controllable drivers. Each opportunity should include recurring savings, implementation costs, timing, responsible owners, and service quality risks. I would test whether a proposal genuinely improves efficiency or merely delays maintenance or investment. For a telecom business, I would protect network reliability and customer experience. Finally, I would track KPIs such as cost per customer, complaints, churn, and realized savings. Focus on cost-based segmentation, savings durability, service quality, customer impact, implementation costs, operational ownership, timing, KPIs, risks, and distinguishing efficiency from deferred spending or underinvestment. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.